and welcome to the Unbiased Investing Podcast. On today's episode, Mike and I interviewed guest Brian Peters. Brian's career in the financial industry is extremely extensive and has been broken down throughout the interview. The main topics on today's interview were first, a series of general investing questions. Secondly, we focused on the advancements in the medical industry. Lastly, we discussed commodities, which was a topic that Brian thought would be very valuable to our listeners. Before we dive into the interview, I want to take a moment to remind you that nothing said on the Unbiased Investing Podcast should be taken as personal financial advice. This podcast is purely for entertainment and educational purposes. With that said, let's get started. And on today's episode of Unbiased Investing, we have our first guest, Brian Peters. Brian started his flourishing career in finance at RBC Dominion Securities, where he worked various roles on his way up the ranks for nearly 25 years and finished as co-president and head of one of Canada's premier wealth management divisions. After his time at RBC Dominion, he served as the president and CEO of RBC Dane Rauscher for 2 years, where his team managed over $117 billion in assets. And to wrap up his career, Brian served as the president and CEO of MD Financial Management for a 14-year tenure, which eventually was acquired by Scotiabank in late 2018 for $2.6 billion. Brian, I hope that was accurate. It came pretty much off your LinkedIn page. But if you have anything to add, feel free.
It was a mouthful, Jesse. Way to go. That was a lot to say. But, the only thing I think that would add a little context to the intro that's never in the bio. My dad was a trained accountant. He became a broker in 1960, way back when. So I grew up, he was at Merrill Lynch. I grew up learning about stocks and investing in my teenage years and started to participate before I ever got involved in the industry. And myself, I decided to be a stockbroker. So, one of the perspectives that I want to share this morning is just, by participating, by being involved, you learn a lot. You make mistakes. Everybody's going to make mistakes. But if you get involved and you try, you're going to ultimately find your own path. And when you find your own path, it's just a wonderful career and wonderful area, space to be involved in.
Awesome.
So Brian, you just want to kind of start off by just giving us, an intro into how you got started in the investment industry and, how you moved your way up into several leadership roles. And, when you look back, what was your key to success in those leadership positions?
Sure. So just, maybe building off the fact that my dad was already in the industry, kind of when I was in university taking finance courses, I kind of thought, well, what do you need to do to be a stockbroker? At that time, it was a Canadian securities course. So I took the Canadian securities course, applied, got in, and started to build up my book at Dominion Securities before it was acquired by RBC. So that kind of dates me, and started building a book, building up clients. Interest rates were 20%, close to 20%. I remember selling savings bonds to Canadians, to my clients at 19%. And so, ultimately the big change for me was going from being a broker to being a manager of brokers. And they approached me a few years after I became a broker to say, do you want to try out management? And I said, well, what do I have to do? They said, well, you join another manager, become assistant manager, keep your books so there's no risk to you, and try it out. I tried it out. I liked it. And it was a fundamental choice for me. I was spending all my time really building up a clientele and picking investments as an advisor, or was it going to try to help other advisors become good at what they do, hire up, run a profit and loss statement, or run a branch. And so that was a fundamental change for me. And I think really maybe the core where you were trying to go, Michael, is I think what really was the key to my success as being a manager or leader of brokers is, one, I'd already done it, so I understood and had empathy for the role and some of the strengths and weaknesses of what you need to succeed. And then the second thing is, I recognize that there's more than one way to do this. And so give people freedom and try to help them solve their problems without telling them what to do, was, I think, a big thing. And, they call it in management laissez-faire, right? Yeah, and it wasn't like there's only one way and it's my way or the highway. It was kind of like, tell me what you're trying to do. Let me see if I can help you, come alongside and coach you along to try to be the best you can be at the approach that you want to take.
Perfect. Quick tangent here. If you could get a savings bond at 19% today, how much of your assets would you put in that?
Well, more than I would have back then. That's
Yeah.
for sure. Number one, savings bonds have gone the way of the dodo bird by and large. And I'm not much of a fixed income guy. My whole stick has been equities. And so even now, as you can see, more gray than not, I don't have very much fixed income. And so, I think I'd surprise you, Jesse, and say probably less than you would think. Some people would think 100%. I would say like less than 25%.
Yeah,
I still think there's more growth in equities.
Of course, if the bond rate is that high, there's some pressure on inflation or something that you're still worried about. The real rate would never be that high. It would just be, yeah.
Yeah, well, you got that totally right. The real rate then was not 19%. Inflation was raging at that point, and they were trying to break inflation.
Fair enough. Okay, well, moving on. If you just had to give one key piece of advice to someone following a similar career path as you, what would that advice be?
It's about taking risk. I think the piece of advice I would say is, you know the qualifications, the path in. But if there's two paths, one to be an advisor and one to be a sales manager, right? If I was saying on the path to be a sales manager, I think I would advise somebody to try to be an advisor first, so they can be a better manager towards advisors and how you hire that up. So that would be my one piece there. But if you're just talking about getting involved in the securities industry or the investment advisory, financial planning industry, I think my one piece of advice is it's not just investments. Money is very emotional, and I think people need to take more of a holistic financial planning approach to their investment picture. So it's beyond the Canadian securities course, which is a narrow sliver of a financial plan, and broadening it out to the whole how do you save? What's your emotional connection to money? What are you going to do to conserve your assets through insurance? Do you have a estate and will plan? I took my CFP, a Chartered Financial Planner course, 2 or 3 years after the Canadian securities course, and nobody at that time was doing financial planning in the brokerage business. It added value.
True. I think one of the biggest things we talk about here is that if you don't know your risk tolerance truly, that when the emotions hit and you end up selling something off, that's the main reason why you can underperform the market, is because
the main reason I've seen in my career, for sure, dealing with clients, is people's risk tolerance when things are going up is very high. When things are going down, their risk tolerance almost collapses to zero. And the biggest single mistake is selling everything when things are going down. This is a sort of buy low, sell high. And when things get scary, people tend to emotionally want to sell, and then their returns get totally imploded.
Mm-hmm. There was a tweet I read yesterday that if you bought the SPY index or the S&P 500 index 1 year ago today, you would have lost 34% in the next 5 weeks and still be up 27% year to date.
So, yeah, the last 12 months was super unusual, but even just take it back, when I started, the Dow was under 1,000. Today it's over 30,000. So, you put $1 in that, you got 30 times your money. Right now, it's over a longer period of time. And I think that's the thing, is people are very short-term oriented right now. And I think it pays to have some attention to the long-term as well.
Perfect.
Yeah. Well, that's a perfect transition into our next question here. So based on kind of both your personal and professional experience in the wealth management industry, what do you see as, the key steps one can take to kind of build long-term wealth?
Start early. start early, put aside money regularly. We have 4 children and they're all putting some money aside, because the money you put aside when you're a teenager, 20 something, even if it's a small amount, can grow way more than money you put aside in your 30s or 40s. So put aside an amount regularly, have it go into whatever vehicle that you think is appropriate for you, and continue to participate. But if you start late, kind of becomes a little bit more of a challenge.
Yeah,
perfect. Well, my next question, kind of on that same topic, what is your opinion on the most recent craze in passive investing versus active management? And does that differ based on someone's understanding of the market? Like if they're more experienced, would they be more inclined to actively manage their account, understanding their risk tolerance? Or do you think, passive investing is the way and should be done by everyone and just take the market gains?
Yeah, this could be a pretty big topic for us, but I think really the rise of passive investing is partly driven by cost. It's a low cost option, right? And it gives you market returns. And you don't need to do much, right? And so you could be a very sophisticated investor, because I've been involved for years and done just about everything, and I still have passives. It's how much time do I want to really put into that space, right? Maybe for just example, I know nothing about robotics, let's say, but I want to participate in the space. So, a passive approach might make sense. I don't need to pick the right investment. I just need to say, I want robotics. There's an ETF on robotics, and boom, I'm done, right? And whereas in other spots, I might want to either try it myself, be the active manager myself, and buy the individual securities, or I may want to choose an active manager that's going to try to pick the 10 best, or the ones that are going to outperform the ones that aren't.
That's kind of my approach with the genomics space as we in the current market, just obviously with ARC's genomics ETF there. I think, Kathy Wood and her team do an awesome job, and they have some experts that are going to pick winners way better than I can. So for that reason, I'll pay my 1%.
We share a common theme there, Jesse, because my son-in-law is a scientist. He's got his PhD in genetics, and he works for MIT. And so we have some great conversations around CRISPR. He knows how to use CRISPR, that uses it in his scientific approach. And so as part of their investment program, they're in their early 30s, they own some ARC genomics. I own some ARC genomics. So just to clear that up front. And I think, again, there's a great example. CRISPR is the top security in that fund, right? But I don't know enough about that, even though I have access to somebody I can talk to around how to invest in that space on individual securities.
For sure. Okay, well, we're moving into our first topic here. So your history kind of in the medical industry. We're talking about innovation in the medical industry and some of the companies that have recently came up in that industry. So some of the companies are Teladoc, CloudMD, Well Health in Canada. And later on, I have a question about Intuitive Surgical. So if I assume you're familiar with some of those companies, you've probably held just being in that space. So what is your opinion on the long-term potential for all the new and evolving telehealth companies?
I think the pandemic has really changed people's perception around how they will interact with the medical community, how we can get more service, remote or using digital. My perspective is also shaped a little bit, Jesse, by the fact that as part of the MD portfolio, the company that I used to work for as CEO, we had electronic medical records business that we were partners with a physician who was an entrepreneur physician, started up the company, and it was helping physicians digitize their records. So it's part of that space. So I've seen the space. We ultimately sold that business to TELUS Health. And now in the last 2 or 3 years, a lot of capital is flowing into these companies, a lot of the names that you mentioned. And so, this is a trend that will endure. It allows to digitalize the whole process from client or patient interaction right through to the physician, and will only be as good as how good the medical records are digitized as well. Allows for low cost, allows for timely access, no waiting in the waiting room. So I think the trend is here to stay. So those companies should have a bright future. And ultimately, the whole idea that technology is coming in a big wave towards medicine and healthcare in general is an enduring theme for the 2020s at least, if not longer, right?
For sure. I kind of agree with that. We're in the information age or whatever in the early 2000s. All the tech boom has been going on. And I think as that tech evolves into the healthcare industry, we'll see some heavy tailwinds for a lot of the companies.
Pretty exciting. There's just so many ideas around it, like robotics and surgery. There's different medicines, different combinations like gene editing and CRISPR that we talked about earlier. I mean, there's a lot of capital flowing in, a lot of initial public offerings, a lot of IPOs in the US, some in Canada as well. So money's coming into the space in a big way.
Perfect. Or a lot of companies in this space have aggressive merger and acquisition strategies. So we just want to get your thoughts on, when does it become maybe too much and maybe they should focus on, organic growth of their business?
So maybe by just the way you asked the question, Michael, I'm not much of a big believer in acquisitions for building shareholder value. A lot of them don't work. In my career, I worked for Dominion Securities. We made a lot of acquisitions, but the acquisitions were great because you had acquired clients and assets. Not so great if you had to meld two different philosophies and management approaches, and a lot of time and effort went that way. In MD, we didn't do acquisitions mainly. We started everything organically. And so my belief is, because of the different cultures and the different way the organizations start up, usually an acquisition loses a fair amount of the key talent. But what it does do is it usually keeps the client base or the asset base. And so it can work sometimes, but I think if that's their only strategy and they're not really looking at how they can grow organically, they're not going to be as successful as companies who figure out their path towards organic growth.
Agreed.
Yeah, that's great.
Okay, so moving on. Intuitive Surgical. They've been a company I've been following for a long time. Their stock has performed extremely well over the last 5 years. And, to me, it just looks overvalued from the fundamental standpoint. So I don't own any shares. I was just curious on what you think their moat may be, and where do you see or how do you see them progressing in the next 10 to 20 years in that advanced robotics space in the medical industry?
It's interesting, Jesse. One of the companies that I got interested in the 80s was Stryker Corporation. It's been around forever, and it's not quite the same space as Intuitive Surgical, but very similar. And it's had more than a 40-year run of where it seems expensive back in the 80s, but every year it seems expensive, right? Because it's growing at a faster rate. The interesting thing today, though, is the PE multiples and the price earning multiples for all these companies is high, right? So they look expensive, but their growth rate is high. And when interest rates are so low, people are willing to pay a premium for the growth rate, right? So, the idea around a moat, or the idea of where a company can do something different that's not easy for others to do. I mean, they're selling, and their revenues are over $3 billion. They're selling hospital equipment at over $1.5 million a pop. So these are expensive setups, right? And they're selling lots of them. And so they work in the specific areas that they're being used for, usually prostate, some other types of surgeries like that, cardiovascular. But the whole theme is there's going to be lots of competitors, I believe, like the miniaturization of the devices, and the use of technology and software and artificial intelligence at some point, and robotics all come together in this space. And that's the moat. Their intellectual property, the fact that they're already in this space with clients, and obviously provide a lot of equipment to different hospitals and physicians and clinics and that, and continue to do research and development and patent development. So that's, again, I think why the stock will continue to look good in that space. And they're not really growing a lot by acquisition either.
Yeah, one of my thoughts on that is just that obviously when you do buy one of these devices, you would have to be trained extensively on the device or to use the devices in some way. And I just think if they're already trained on Intuitive Surgical's machines, well, then switching to another company and retraining all your doctors on some other device from another company, that's a pretty big cost in itself. So I think that's one of the moats I see, but I was just curious to hear your thoughts as well.
Kind of going back to gene editing here, how big of an impact do you really see it having on humanity over the next century? And is this a space that you are investing in personally?
So I already said earlier, yes, invested in personally through the ArcGenomics, ArcG, not in the individual securities themselves, although and leave the door open for that at some point. Just totally believe that. I don't know about the next century, but how about the next 10 years, the next 10 to 15 years? Huge impact, huge impact. This is groundbreaking research. When you can look at gene expression and how genes work and interact and actually modify them, I don't think our imagination is even caught up with all of the impact that this is going to have on us as human beings and on society as well. It raises a lot of ethical questions. Would you, when you guys are having kids, if you ever, get to the point where you're having kids, would you subject your kids or yourselves to gene editing to be able to shape the way that your children are going to grow up? Well, it's a complicated answer, right? If everybody else is doing it, you don't want your kids to be the ones falling behind, and so you might do it because everybody else is doing it. Anyway, that's a whole tangent and aside, but I think it's going to have huge impact.
Yeah, I agree for sure.
Okay, well, I think it's about that time where we open the floor to you. Is there a topic that you want to bring to the table and discuss with us?
Yes, there is. There's one topic that I thought that might be of interest right now. So I'll start off and say that the word that I wanted to bring is commodities, right? And so Canada's we have a lot of oil and gas, we have like some timber, we got mining companies, we got agricultural crops. So we're seen as a commodity-based nation. And for large periods of time that underperformed, and I'm going to say the last 10 or so years it has underperformed, but we're starting the beginning of maybe a longer cycle, whether it's 5 or 10 years of good performance in commodities where these things will perform. And so it ties then to the bigger theme of what's going on right now. This is very, very different than my whole career, last 4 decades in investments, where we have floated a lot of money, trillions of dollars into the world economy to stave off a potential depression. But, could have, like through the pandemic or the great financial crisis of 2008-9, we could have fallen into the abyss if we didn't, if the policymakers didn't float a lot of money. So there's a lot of money out there. And so what is the impact of that? So some people say we're going to go into inflation. And then there's this whole move to cryptocurrencies, hard assets like gold, real estate. You pick it, you got to sort of, if you're in that camp, you got to have a whole set of ways that you are going to try to protect the value of your wealth or try to grow your wealth through that. And then there's this commodity space as well, right? So, copper's gone way up, lithium's gone way up, because we also have this whole technology change towards electrification, electric vehicles. And so the suppliers of some of this are going to do quite well and have done quite well already. We can take sort of a look back in history and say back at the turn of the century, the 1900s, there were hundreds of automobile companies as that new automobile industry took off. And then it consolidated into a very few over decades, right? Well, it's almost like deja vu in the 2020s. Now we have hundreds of electric vehicle companies starting up with massive valuations. And ultimately, that industry is going to consolidate, and there's going to be fewer companies, and some of these high numbers that people are paying for the current price isn't going to be there. So you could take a look at that space and say, you know what, I'd rather play the commodity. I'd rather buy the copper stock or the copper itself or nickel or silver or, if you're in agriculture, you could go through commodities as well. You could buy nutrient. You could, there's a variety of different ways that you can play the commodity cycle. And I think that's the point I wanted to bring to the table. I think it's you can't be a successful investor today without having your point of view around how the amount of money that's been put into the world, into the system is going to play out for investments. And so I think that leads to all kinds of different questions you guys might have. You want to point me in a specific direction, be happy to go there.
Yeah, I mean, I definitely can relate to your whole EV sentiment there. Like, I believe it is a big future for the world. It's going to change the way we, change the future, I guess. And the valuations are extremely high. And one of my theses is when I start getting instant messages on my DMs about all these different EV companies, I know that's the time to get out of that area of the market. And Tesla is my biggest holding personally, but I invested in 2018 and early 2018. So I've let that compound over time, and I just don't sell. But I definitely am not a buyer at the current valuations of any of the electric vehicle companies. I just have a very long-term perspective, and I don't want to sell a company that I truly believe in for the next 5 or 10 years. So until I see any underperformance in some plan that they kind of present and miss on, well, that might change something fundamentally in the business. And at that time, I might think about selling a portion of my shares. But their execution has been phenomenal in all of their plans and strategies. So for that reason, I just don't see myself selling any Tesla soon, even though it is probably overvalued in any way you can look at the metrics.
Yeah, Tesla's a very interesting story, but there's lots of them. There's lots of Teslas out there. Ballard Power in 2016-17 was $2 a share, $2.50 a share, and it's now 45. It went up over 50. It's 40, 45. Lithium Americas, $4 last year, 24 today. I mean, I can name a whole bunch of these things that have gone up a whole lot in the last year or two. And so today's question is, well, so how do I participate in what's going to happen going forward? And as prices keep going up, it becomes more and more difficult to find something that you feel comfortable buying that has good value. So some people are paying prices today that if something happens that we can't predict right now in the marketplace and sets off a little bit more fear rather than just greed, some of these prices will come down fairly dramatically. Mm-hmm. So hey, look, that's the market. It goes up and it goes down, right? So yeah, as long as you're not.
I think one of the things you're mentioning here that a lot of people don't understand is there are multiple ways to get exposure to these industries, and you don't have. It's not always by that company, right? Like, you can look at their supply chain and figure out exactly what they rely on and what prices should correlate in some way to that industry. And you can find much better value in a lot of those companies.
Right. So I'm not saying this one is exactly the one where you would find value, but it's an example to sort of support the point you're making, Jesse. So Musk has a point of view on how his autonomous vehicle fleet will actually see the world. And it's not a laser-based system. So Luminar is a laser LiDAR-based system that other platforms are using. He has a point of view on that, not going to use it, doesn't work well enough for what I want to do. Luminar is a way that you say, it doesn't matter which company, whether it's Volvo or ultimately Tesla or what, they're just making the software and the lasers that are going to go in autonomous vehicles. So, I'm not saying that's good or it's bad. It's just, it's an example of how I like to think about markets. Rather than picking the winner, the ultimate winner, I like to pick the suppliers where multiple companies in that space are going to have to use a supplier. So 5G, for example. So who makes antennas? Who makes base stations? There's a chance that there's going to be thousands of Earth surrounding the Earth. Well, okay, I can either try to pick the satellite providers, there's only a few of them, and play it that way, or I can try to pick the equipment, the 5G equipment and base station manufacturers. And that might be a better way to go at it because people aren't looking at it quite the same way, right? There might be more value there.
Yeah, and instead everyone's buying the company making the 5G chips, where you're looking at the kind of the bigger assets that make that technology even possible.
Yeah, the chip manufacturers, that whole semiconductor space has been super hot, and we're in this whole new growth period for technology, so it's going to continue to do well. And I think there's a whole lot of things we could talk about technology, but for semiconductors are really important for technology. So the fact that car manufacturers are behind on their production because they can't even get the semiconductors, they're going to gamers, they're going to different applications. That's the first time that's happened in this to this extent. And it's pretty interesting and telling that, we got to ramp up production of semiconductors, which isn't an easy thing.
No. Michael, do you have any thoughts on that?
No, not much to add there. I think you guys discussed that very well. Like, especially when I have a lot of friends asking me about, they want to invest in like companies like Tesla or Neo. And it's hard to give them a yes because I mean the valuations are so high, right? But that's a great point you guys made. Like, look for other value elsewhere, and potentially you can find something that is undervalued, and that would be a good investment. So,
perfect.
Well, an investor in either Tesla or Neo today has to have a very optimistic view of the next 5 to 10 years. If you're putting new money in today, you have to be very optimistic about what the potential is. Just without belaboring the point, if interest rates rise at some point over the next 5 to 10 years, and that I think is a reasonable likelihood, then the value that these companies, the multiple that you're willing to pay on earnings goes down. So the company could still be good, still be really exciting, still doing fantastic things, but the price will come down because there's a change in the interest rate picture and the price that people are willing to pay for the earnings.
I completely agree. Yeah. It's more the direction of the interest rate that it's moving, that the market sees for sure. And we've been moving down for so long, and we can't really.
My whole career,
low.
Those 19% bonds would be under 1% today, right?
Yeah.
So that's wind at your back for sure.
So that's definitely, I think, the argument that growth stocks have outperformed value over the last 10, 20 years. And you get to this bottom where, it's got to change eventually. So I think as interest rates rise, which I see as one of the major risks to the market overall, when we do see that pull back. So I think it is important to have some exposure to companies that are in that value space that you think will be able to hold a decent value. Like, I don't like to be out of the market, right? I would never just sell off my assets because we're not in that game trying to predict interest rates or anything. But I do definitely think you need to have some exposure to some good value plays in case those do go up, and just kind of hedge your bets there.
Talking about hedging your bets, the whole area that I mentioned earlier around whether it's cryptocurrency, whether it's a precious metal, whether you can afford land, the whole idea of something that's a hard asset that can withstand inflationary pressure if it does happen is a good diversification of your portfolio. So there's been, Reddit and the whole threads around some of these defunct companies, but the most interesting one recently for me was silver. And, there's for years and years now, the amount of mined silver is not enough to meet the demand ultimately for the solar panels and all the other industrial uses that silver is used for. And so it's a great conductor of electricity. And so unless you can find a substitute metal, and that may happen with technology, the demand for silver is going to go up and supply is not going to be able to meet the demand. And it's kind of like a hard commodity asset that is a good diversification. That's good value now, right? Like reasonable value now, as is gold, as it, cryptocurrencies. It was last year you could buy Bitcoin, probably around 5,000 or 7,000 a coin, and now we're 51. This is American, 51,000, 52,000 today. It's had an amazing run, and everybody's jumping on the bandwagon right now. But what I really like about the idea or the concept is it's seen as a store of value to protect your currency against a collapse or against a debasement, as they call it, right? And so I would say that I'm speaking to the decisions I've already made. I have more precious metals and more commodities than I have cryptocurrency, because I don't like the fact that it's a digital asset right now that the rules can change from a government perspective. I don't think they're going to, but with a stroke of a pen, could affect my my investments. And so a little bit's there, but not I would not advise anybody to be overextended in cryptocurrency, although people who've done that have done extraordinarily well.
Yeah,
So
of
very
course.
well.
But the past doesn't predict the future there, right? I'm a huge bull on cryptocurrency, but my personal motto would be not to have more than like a 10% exposure of my net worth in that space, just strategically, because I have no idea where it's going. And you see all these risks in the long term, but you also see this massive bullish trend and this like stock to flow model that decreases exponentially. So as that happens, the value has to keep, increasing, and it's outperformed every other asset, and it's the most uncorrelated asset to anything else.
Yes, it is.
So for that reason, I see it as an awesome part of a portfolio, but it should not be an overextended piece of that portfolio.
Yeah, you said it. You said it very well. It's attractive for a lot of different reasons, and more and more people are discovering and or making it part of their portfolio. Just as long as you don't overextend yourself or get too crazy about it, you'll do fine in the long term, right?
Mm-hmm. Yeah, that's a space I've been doing a ton of research on, and so I'm going to tie this back to your silver question. Some of my exposure right now, most of my exposure to cryptocurrency is actually in the public mining companies, just because of in the bull market and with the semiconductor shortage that we see right now, it's impossible for these miners to expand, and their profitability is going through the roof as the price of the Bitcoin goes up and everyone's trying to get into mining. So they have some major leverage right now.
And they have a moat. Yeah,
exactly. Yeah. So that's what I wanted to tie back to your thoughts here. When you're investing in the silver industry, are you buying the hard asset, or do you have some exposure to the miners, or are you all miners, or do you see a difference there? What's your...
That's a great question. It would be on capital. It would be part miners and part the actual metal itself. Right now, the metal has gone so expensive. So for $27 US an ounce silver, you can't buy a one ounce silver coin for anything less than about 40. So there's a premium. You're paying $40 an ounce for the actual coin, when the commodity itself is around 27 approximately. So, if you haven't already done it, I would not pay that kind of premium for the actual physical silver. So right now, the miners are a better investment, and it fits the whole theme of what we've been talking about. Just like you're buying the miners of the cryptocurrency, the miners of silver have leverage, right? I mean, as the silver goes up $1 or $2 an ounce, or $5 or $10 an ounce, all of the thousands, hundreds of thousands, or millions of ounces they produce goes up. Their costs pretty much stay reasonably the same. And so a lot of cash flow flows into the balance sheet. They can either pay that out, make acquisitions, buy back shares. And I'd say the precious metal companies right now and the copper companies, they look, their financial positions are way improved. And they've got new religion, because back the last time that this all happened, and it was really good, they made too many acquisitions, paid too high of a price, and they misallocated their capital. So now they're holding on to their cash, and they're trying to think about dividend policies and returns to shareholders. And I think they're just a different class of investment vehicle, a little more attractive now than they were 10 years ago or 15 years ago.
So like when you're looking to invest in a particular miner, what specifically do you look for? Like what makes you comfortable investing in one of those companies?
That's a really, so for this, let's just pick the gold or silver mining, where we're on the same theme. If you can get a domestic producer, North American, that is going to be for me, a really key criteria. As some countries fall into poorer and poorer financial shape, they'll either nationalize the mines or potentially nationalize the mines or put some capital tax on. So you might think you have a great gold stock, but it's the money's coming out of somewhere in Africa, and the country slaps on a capital tax or nationalizes the mine, and the value of your company goes down. So I think criteria number one for me is North American. That would be the golden standard for me for investing in a company like that. The second one is do you want actually a developer, like somebody who's exploring a resource, like a developer of an asset, or do you want somebody who already owns mines and is just producing the gold and gets the leverage that way? And then the third way to look at it is you can buy a streamer. They don't even do the mining. They buy the stream. They finance a mine. Let's say Nico Eagle wants to sell production off this particular mine, 100,000 ounces. They'll sell it to Franco-Nevada, and Franco-Nevada just gets the revenue stream off that, and then Agnico Eagle gets the money to develop the mine. So a streamer is kind of like a dividend payer. Producer like Agnico Eagle, just use that as an example, is a big producer, big Canadian domestic producer, and that's a good way to do it. But I also, just the way I'm built, I like the explorers, because if you can get the explorers, you get the double leverage, right? You get them going up way faster than either the streamer or the developer, or like sort of the producer, the producing mine like Agnico Eagle. So my commodity-based securities are tilted towards right now a little more risk in the exploration and development space than the pure, but I own some actual producers and I own some streamers.
So when you talk about the three tiers there, the developer, the miner, and the streamer, would your theory be that, obviously the developer is the most risky, the miner might be second, and the third would be the streamer? And then the reason
Yes.
why you expose yourself more to the developer is because you believe in the, a greater risk is a greater return over the long term?
Yes, that's exactly 100% right. Couldn't have said it better. Right now, I think because we're relatively at the beginning phases of a commodity cycle for this decade, I believe, because of the inflationary impact we talked about, that it's worthwhile having some of my capital allocated towards the more risky part of that asset side, because if you get it right, you're going to have a 3x return or a 5x return or even a 10x return, where you do fine in the producers and the streamers, but not to the same extent as you will if you get the right explorer.
Cool. Perfect. Well, my last question was about crypto, but I think we went
we covered that
a couple times.
Yeah.
So I don't know. I don't have any other questions for you. I think that was really good. Michael, do you have anything that you would like to ask? Or
No, nothing really to add.
Can I say there's probably some people in your audience who would be interested in picking up or learning more about how to invest, and we could do this another time, or I could send it in afterwards. But I have a couple books that were really influential in how I think about the marketplace that I would just offer up. One that's really old, it's an 1800s book, but it's The Extraordinary Popular Delusions and Madness of Crowds. So it's all about crowd psychology and how things like the tulip bulb mania and a variety of other things get into a big boom time and then a big panic, right? So it just talks about market psychology. O'Shaughnessy wrote a book called What Works on Wall Street. And it goes through all of these different, whether you're value, whether you're momentum, price earnings, whatever. I think that's you got to know what works, right? William O'Neill, How to Make Money in Stocks. So William O'Neill, Investor's Business Daily, has been a source of mine for decades. And I really like, for growth and momentum, it's a great read and a great way to sort of investigate a little bit more. And then if you really want to get more into the trading area thing, Jack Schwager, Market Wizards, he's got Market Wizards 2, and they'll give you profiles on some of these guys who've made gazillions of dollars and how they approached it, but more importantly, how they think. And so the game of investing is not a game. It's actually an approach. You got to know yourself and how you handle risk and your emotions. And if you even just started with those 4 books, you'll become a better investor, better trader.
Perfect. Well, we'll definitely take those 4 books, and for the listeners, we will attach their links on Amazon in the description of the podcast. So if anyone wants to grab that book or any of those books that Brian described, look in the description and you can find the link there.
Awesome. Thanks, guys.
Perfect. Thanks for joining us today, Brian. It was awesome, and hopefully we'll have you back in the future.
See you guys. Thanks for having me.
Thank you, Brian.
Take care. Bye-bye.
Take care.